Hello friends. Last week in my video, I examined the popular notion that was floating around in the public domain about how and if the Nifty could hit a new high in the month of October, preferably even last week. But I presented a set of data points based on a statistical trading model, the IBEX, which told you that the banking stocks were weighing down on the markets and therefore a new high in the week was very, very difficult. I've been putting up a lot of additional write-ups on our free Telegram channel. That's one place where I share the most amount of my data, and you can feel free to join that community. It's absolutely free. And this week, I want to examine the fact as to whether the ongoing war in Israel is actually impacting sentiments in the markets and whether bulls are getting nervous about a protracted and prolonged war. Now, this week, the primary focus has been on the Israel Hamas war, and the statistical evidence that I had presented to you. Also remember, I had presented to you a relative comparison between the Nifty and the Bank Nifty, which showed that the Bank Nifty was showing very tiny returns over a 20-week period, and the 12 and 4-week returns were actually into negative. Now, I've often written this in my live mint column that the Nifty and the Bank Nifty are two wheels of a bicycle. Do you think that a bicycle can be ridden smoothly and dependably without any accidents if one wheel is moving in one direction and the other wheel is moving in the opposite direction? It's not possible. So as long as the Nifty and the Bank Nifty are moving in divergent directions, a rally is not likely, which is the entire point that I tried to make in the previous week's video. Now, since the weakness was actually in the market since many weeks, the Israel war itself is unlikely to be the be-all and end-all reason why the market is appearing nervous. Yes, it is one of the reasons, but it is not the only reason. I also present a certain other weight of evidence. The number one being the price of copper, as you can see on the weekly chart of MCX, that the price of copper is down 22% since the high it made in March of 2022. Now, the classic Dow theory tells us that any security that falls 20% or more from its peak is deemed to be in a bear market. So you are actually in a bear market in copper. Hey, if you were to look at the price of aluminium and lead, you would see that the declines are even more pronounced, even deeper, which means they are deeply into bear markets, which is why I have been telling my online family that I do not subscribe to a super cycle theory in commodities, whether it is base metals or it is energy, oil and gas. So here you have it. Industrial demand seems to be headed lower, which is why these metal prices on commodity exchanges are sinking progressively. The other aspect that many large corporations, KPMG, Google, Nokia, Rolls-Royce, these are just a few names that I have named. They are laying off people. They are cutting jobs. If they are not cutting jobs, they are cutting salaries. These are not times when super cycles are seen in commodity markets. So, which is why the optimism, at least in the commodity space, is completely misplaced, and which is why I have been telling you either through my media articles or in my media interviews, wherever I'm appearing in videos, that I do not subscribe to a super cycle theory in commodity markets. Bull market maybe, yes, but not a super cycle. And even in the stock markets, I think the worries have started a whole lot earlier, and we are going to take it forward from there and see what the statistical weight of evidence is presenting to us. Now, Dr. Copper, I told you. And the other hypothesis that is going around in the market is that electric vehicles and solar power will require copper cables, and therefore the demand for metal, the metal will go up. Now, since copper is an excellent barometer, that's why it's called Dr. Copper in commodity trading circles. Since it's an excellent barometer of the way industrial demand is going, you also need to understand that new housing bookings, housing starts as they are called in America, are at kind of 28-year lows. So people are buying fewer or booking fewer new houses. And there, in the construction industry, copper and aluminium demand is substantial, and it is likely to come down because new home sales are falling. So it kind of balances itself. That bull market super cycle theory seems to be kind of overdone. Now, will the war actually see a major decline in the sentiments? I would say yes, only if Iran enters the war, if dirty bombs like nuclear and chemical warfare is resorted to, and Iran so far has been a kind of a proxy through Hamas and Hezbollah, but not really direct. So I don't see that happening unless I don't see the markets falling because of the war unless Iran gets more proactive. Also remember that the coming week has two major events. One, expiry of the October series, which is when a lot of positions may be just squared up instead of 100% rollover, which never happens. Some positions may be squared up. And also, the coming week is shorter due to a holiday on Dasera on Tuesday, which is why, again, aggressive risk taking may not be seen in the week ahead. Friends, the promised statistical analysis of the market, which I told you about, let's get down to the basics. And on your screen right now is the daily market roundup. The weekly market roundup. It shows that the Bank Nifty led the way forward by falling more than the Nifty 50. The US dollar index for a change fell 51 basis points, which triggered a safe haven buying in gold and silver. And crude oil also went up due to a weak dollar. And of course, fears of a protracted war. Natural gas prices fell a little under 11%. The primary reason was the winter was seen to be forecast to be less harsh than feared earlier, and secondly, workers and the Chevron management at Gorgon and Wheatstone plants reached an amicable settlement, and a strike has been averted. The US dollar versus the rupee fell 19 basis points. So the strength in the rupee kind of cushioned the declines in the Indian markets. Indian 10-year benchmark bond yields continued to rise, and they're now at 7.36%. NSE market capitalization was down almost a percent, and the three major US equity indices were uniformly down, which provided headwinds to our markets. The advanced decline ratio chart on your screen, the weekly chart, tells us that the Nifty logged bigger losses as compared to the prior week at 1.06% declines, but the advanced decline ratio fell off a cliff from 1.80 in the prior week to 0.87. Do remember that I had told you that these lofty 1.80 advanced decline ratio is unlikely to sustain, and that's precisely what has happened because statistical evidence and history was against this level sustaining itself. Coming now to the MWPL. Now, the MWPL chart tells us that it rose routinely. Now, NWPL is market-wide position limits, is the extent of exposure utilized by the traders as compared to the percentage exposure allowed by SEBI. So, sure enough, it rose to 38.85, and MWPL rises till the week before the expiry, which is how you're seeing gains. Although the 38.85% is higher than the September expiry peak at 38.43, it is far below the August peak at 39.27. And since the coming week is an expiry one, I don't think you're going to cross 39 point whatever level that it is on a week on week basis. So risk appetite seems to be just a little milder. Do remember, this is war, and plus there are shorter weeks. First of all, Gandhi Jayanti, 2nd October, then you have Dasera on the 24th. So the risk appetite is naturally somewhat lower. I'm willing to give a benefit of the doubt for that. Now I come to the turnover, the index and stock futures turnover. Remember, this is concurrent turnover of three derivative series. So it's October, November, December. Turnover has risen on a week-on-week basis, and the stock futures turnover more pronounced than the index futures turnover because of the sheer volatility that we saw last week. And if the markets are falling and turnover is rising, that would be a sign of mild concern, because that would indicate that there is not only willing participation, but there is also a kind of deliberate selling bias by two Marshmallow traders. Friends, I now come to our in-house indicator, the impetus, which you've been trusting for over 2 years now. What you are seeing is the impetus for the Bank Nifty rose in spite of the fact that the Bank Nifty logged bigger losses, and the impetus for the Nifty fell in spite of the fact that the Nifty lost ground. Now, this tells you that the selling in the Bank Nifty was, relatively speaking, more forceful than the Nifty 50 itself. This kind of validates my point that the Bank Nifty is relatively, compared to the Nifty 50, far more weaker as compared to the broad-based Nifty, which is where the weakness in the market lies. If the market is to fall, I think the Bank Nifty would drag the markets down. Do remember what I told you in last week's video. The Bank Nifty contributes almost 1/3 of the entire weightage of stocks in the Nifty 50, the banking and financial sector services, that's what I mean. And the information technology, IT stocks, contribute approximately 14% more. So put together, you're looking at almost 50% weightage in the Nifty 50, and the stocks in that sector, in these two sectors, are somewhat weak. And therefore, the Nifty is being dragged down by banking and technology stocks. Friends, I now come to the LWTD indicator. This is something that I introduced you to almost 1.5-2 years ago, and you've been trusting it all this while. Now, what you are seeing is the Nifty, of course, clocking 1.06% declines last week, but the LWTD has simply collapsed. It's fallen to minus 0.24 as compared to plus 0.18 in the prior week. That tells you that as far as expectations of fresh buying support is concerned, you should not be expecting too much by way of support from bulls. Of course, the fact that you have a short week due to Dasera, the fact that you have expiry on Thursday, due to which fresh buying obviously will be a little more milder, those reasons apart, it is also the fact that you are basically seeing the LWTD warning you not to be too aggressive on the buy side. Friends, I now come to the Nifty and Bank Nifty basis. Basis is nothing but the discount or premium enjoyed by the future as compared to spot. What you are seeing is the Bank Nifty basis, indicated as a red line, collapse significantly by a huge margin. The basis is a little under 16 rupees as compared to 106 rupees in the week prior. But that was expected since banking is weak. What worries me is the basis which is inverted, which means negative
for the Nifty 50, the broader based Nifty 50, from -9, which is 9 rupee discount in the week prior, you're at 14 rupees 80 naya paisa discount last week. So, to that extent, two consecutive weeks of inversion is something you have not seen in the last 20 weeks period covered in this chart. This is one major indicator that two marshmallow traders, the marshmallow theory is explained in a video whose link is in the description and in the pinned comment below. So, two marshmallow traders are pressing short sales for a fortnight in a row. Coming towards expiry, if the basis remains inverted, that would tell you that the bears are short selling the Nifty even though they are paying a premium for shorting. Remember, the basis is inverted. If the basis was positive, a short seller receives premium. Here he's paying a premium to go short. If they're paying a premium to go short, they're expecting the market to fall. So basis is the highlight of this week's statistical data. I don't want inverted basis in the week ahead.
Friends, our in-house indicators done. I now come to the bond market, which I have been telling you should not ignore. One of the reasons why the market is falling nowadays is because bond yields are rising globally. As a matter of fact, you are seeing the US 10-year bond yield at 5%. This is not something that many people expected. If you have been connected with me on social media, particularly our free Telegram channel, where I put in most amount of data, I have been warning you since 2 years now that interest rates are not transitory. Inflation is not transitory. Interest rates are not rising temporarily, and there is no super cycle in commodity markets. I've been constant about these three factors. If you think about it, they are related. All right. So now what's happening is RFR, risk-free rate coming in from bonds, is hitting 5% in the US. Can you actually guarantee 5% return in stocks? No, you can't. It's a feast of funeral investment. Stocks can either double and triple, or it can halve or even fall further. So here is the bond guaranteed by the US government giving you 5%, whereas stocks you're taking a risk. Where will investors go? So whenever fixed income yields are rising, people tend to readjust or recalibrate their investment mix between equity and debt, and therefore debt is getting higher allocation. In India also, what you are seeing is the Indian 10-year benchmark bond yield has gone up 4 basis points last week and now stands at 7.36. You've seen a clear close above the downward sloping trend line, and I stand by my commitment that at 7.55, 7.6, I will send you updates via our Telegram channel as to whether we can start laddering in the sovereign or any other government guaranteed investments out there. I'm keeping the powder dry. I'm waiting in the wings to deploy. So should you. Friends, the bond yields done. I now come to the Bank Nifty, which bore the brunt of the selling. And as you can see on the daily chart on your screen, the Bank Nifty has fallen on 4 out of 5 trading sessions last week and clocked 1.28% declines. The price is below the month-long moving average, which itself is sloping downwards. And there are two head and shoulders that I have marked, one that started in July and the other that started in August. The one in August is marked with a neckline which is blue in color. That neckline has been violated on Thursday and Friday. The price has closed below this neckline itself, and unlike the previous head and shoulder, this price has closed below the neckline. If it does come above the neckline to test it and barely stays there for a day or two and falls again, that would be a fail-proof confirmation that declines are here to stay. Now, the outlook is fairly nervous for the simple reason that the worst case scenario in the coming few trading weeks should the war escalate, should Iran get dragged into the conflict. In a worst case scenario, I think you could see a 2000 point decline on the bank nifty. I'm not saying it's guaranteed, I'm saying you should be prepared. Now, do remember the banking and financial sector services have a contribution of almost 1/3 in the Nifty itself. So if the bank Nifty falls, you can't rule out a Nifty being dragged down as well. Coming now to the weekly chart of the bank Nifty, there are two things to note here immediately. Number one, the price has closed below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which means the medium-term outlook has turned weak. Secondly, I have drawn a wedge formation, which is like two trend lines converging, not yet touched, but converging. And this price is at the support line, the lower trend line of that wedge. If at all this trend line is violated, you could see declines accelerating. Do remember, this is also a head and shoulder top formation on the daily chart. On the weekly chart, you have a wedge. Your price is below its 6-month long holding on cost, the average cost. So buy and hold investors are definitely sweaty under the collar. And what is the gravity of the closing below the moving average? Well, it's closed below the 25-week exponential moving average for the first time after week ended 31st March 2023. That's almost 7 months. That's big. So now we basically see that a fall and close below the head and shoulder neckline opens the doorway to a possible another 2000 point decline. The 46,350 odd levels is now a double top formation, as you can see on the weekly chart on your screen. And if at all you think the bulls are coming back for good, they will have to take the bank nifty above the 46,350 and close consecutively for a week or two above that. Then it would convince traders that bulls are back. In the week before last, this index was number 6 on in-house statistical beta list of most volatile counters. That's where it stayed at number 6. Last week, I advocated a possible range between 45,375 on the upside and 43,200 on the downside, which held perfectly well. In the coming week, I anticipate a range between 44,800 on the upside and 42,650 on the downside. Friends, on our Telegram channel, I put up daily, weekly, and monthly pivots of the indices, commodity futures, etc. Do log in at least once or twice a day and before the market hours to check these pivot levels, which will help you trade intraday, swing trade, and buy and roll over or sell and roll over trades, depending on the time frame that you're looking at. Friends, the bank nifty done. I now come to the Nifty 50, which basically fell less than the bank nifty, but it did clock 1.06% declines nevertheless. And what you are seeing on the daily chart on your screen is that this index closed with declines on 4 out of 5 trading sessions. The price is below its month-long moving average, which is going sideways. The price has basically closed at the support level of a blue trend line, which has formed after March 2023. So it's a 7-month-old trend line, which is holding the Nifty up. Should this trend line be violated, you could see downsides opening up. The previous swing low at 19,224 is marked with a green color trend line, which is the low of a flag formation. If this low is violated, bulls are in trouble and fresh downsides may open up. I don't know what can trigger it. Maybe news from the war, maybe expiry related unwinding. We'll know the reason when we reach there, but 19,224 is an area to watch out for. The weekly chart shows a bearish candle formed which is contained within the prior week's bullish candle. So that's like an inside formation as per the Western bar charts. Now, this may be a sign of the upward momentum slowing down, which is why the candle is smaller and contained within the previous candle. But confirmation will come if the low of the prior week, which is 19,512 in the cash segment, is violated on a sustained closing basis. Do remember the coming week is short by 1 day, so that could be another reason why buying may not be very, very aggressive. The price still remains above its 25-week exponential moving average, so the medium-term outlook is optimistic as of now. In relative comparison, this chart looks a little more stronger than the Bank Nifty, which is played out by the relative returns that I have showed you earlier. Now, will the Bank Nifty or the Nifty fall significantly? Now, that's a very, very relevant question. How do you know whether these indices will fall? Hey, take the weightages of the top 5 stocks in the Nifty itself. I assure you, they'll be approximately 50%. In the Bank Nifty itself, the top 3 or top 4 weighted banking stocks in the Bank Nifty itself will be a major chunk of the weightage itself. Last week, I have recorded a video and giving you 5 signs about a stock likely to fall sharply. And yes, these signs can be seen in advance. So do this study of whether the stocks are going to fall on the most heavily weighted counters on the Nifty and the Bank Nifty, and you can make an educated guess as to whether the indices are going to fall. That video is in the description below this video and in the pinned comment below this video. Don't miss it. In the week before last, this index was number 9 on our most volatile counters list. It sank 4 notches to number 14. And that means the relative volatility across individual stocks rose more than the Nifty 50 itself. Last week, I advocated an estimated range between 20,125 on the upside and 19,350 on the downside, which held perfectly well. In the coming week, I would watch the 19,925 levels on the upside and 19,150 on the downside. Do watch our pivot levels. As I mentioned earlier, they are on our free Telegram channel. The daily, weekly, monthly pivots will help you trade better. Friends, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite by the extent of turnover that they have contributed in the week gone by in the 4 segments of the F&O space. The index futures turnover was constant. It is shown as a blue line, which is unchanged. The stock futures turnover, which is shown as a red line, went up by 14 basis points. Do remember, futures demand a higher degree of commitment of capital by way of span margins and mark-to-market margins, and they are more volatile than options. So yes, retail risk appetite was there, whether it is because of rollover ahead of expiry or whether it is participation by 2 Marshmallow traders, the fact remains that risk appetite was higher. Now, where index options are concerned, they are shown as an army green line. Contribution went down by 46 basis points. These are the least volatile and cheapest options to trade, and the turnover fell there. Compared to index options, stock options are more volatile and demand more money as span margin or premium. Here, the turnover went up by 32 basis points, so risk appetite in the riskier segment was high. Net, I would say retail risk appetite was higher last week, and therefore, it means that the market has not given up hope yet. But yes, if the war gets more hostile, then it could be another picture altogether. Friends, I now come to my trading strategy for the week ahead. Like I mentioned in the video on how to gauge whether stocks are going to fall in the future, I will target those stocks in the coming week where the MWPL has been kind of built up substantially. Why? Because if push comes to shove, selling will be the highest here. This is like a crowded exit. You're in a cinema hall. God forbid there is a fire in the cinema hall. Everybody is rushing out for the exit door. If at all push comes to shove, high MWPL stocks will be the most and the first to react. That is where I'm going to put my money in the week ahead. Expiry and nervousness of war could be other extraneous factors that could add to the crowded exit. PSUs and interest rate sensitive sectors remain my favorite because I think rates remaining high is something of an anathema for a bull market in equities. I have already shown you this relative comparison between the Nifty and the Bank Nifty. It's very clear that interest rate sensitive stocks are nervous. So I would target those for my trades in both directions. Oil and gas remain volatile, but I remain of the opinion that upsides will be limited and news dependent on the war, of course. I have written detailed editorials on our free Telegram channel where you can basically go and update yourself. Theta decay in the option segment to earn above average returns on investment in deeply out of money strikes is still in the game, but like I mentioned last week, with tail risk hedges. That's an evergreen strategy and very little chance of going wrong. But do remember, this is wartime, so your exposure needs to be very, very small. Gold and silver show signs of having started on a pre-Diwali upthrust aided by safe haven buying due to the war in Israel. And metal prices on commodity markets are showing signs of weakness. I already shared a weekly chart of copper earlier, showing you how Dr. Copper is showing signs of nervousness. Check out aluminium and lead, and you'll see that the picture is even more bleaker where these metals are concerned. So there you have an entire game plan ahead of you. Friends, how did you like my video? How do you like our workout here? Do let me know in the comments segment. If you haven't subscribed to my YouTube channel, now would be a good time to hit the subscribe button. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And hey, help me reach out to smart traders like yourselves by sharing my videos with your family and friends. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bambani signing off for now. Take care. Have a profitable week ahead. Bye-bye.